This is the final module of behavioural finance, and at the back end of behavioural finance here, we're applying a lot of the behavioural traits and ideas that we've seen along the way to different scenarios that we see in the investment advisor, client and market type setup. So the three scenarios that we're looking at here are analysts writing research, we're looking at investment committees making decisions at committee level as a group, and we're looking at the market, the impact on markets as a whole of behavioural traits. So first up, analyst forecasts. Analysts, of course, you know, investment banks, they write research on companies that have issued securities, and there's three primary areas where behavioural traits and biases can come through in that process. First up, analysts could be overconfident. They might believe they have insights which give them the ability to make forecasts in a way which is beyond actually their actual capacity to make forecasts. So we're not saying that analysts don't have insights that others don't. They do. They should do. Analysts should have insights that others don't. They should have better information than others. But the key issue here is that makes them overconfident. That makes them think they're better than they actually are, right? That's, you know, this belief in this information that they've got is emphasized, if you like. Also the way that company management, so the company that they're covering, the way that company management interact with them, either consciously or subconsciously, company management that have issued securities that are the subject of the research, they're going to present themselves in the most positive light, and that company management, either once again consciously or subconsciously, they're going to really believe in the company, and that's going to come through when they interact with the analyst. And thirdly here, you know, we're going to see some cognitive kind of information processing traits which might affect the analyst's conclusions. So if they collect too much information, you know, that might lead to an illusion of knowledge, which could feed into the first one, overconfidence. This illusion of knowledge is really driven by the feeling that if you collect more data, then you become wiser. Now, certainly, once again, that's a sensible conclusion, but we might think we're more knowledgeable than we actually are through collecting more data, and that might be a reason we become emotionally overconfident in our ability to forecast. So we're going to deal with each one of these individually. This is kind of like a menu for the next few slides. Overconfidence, number one, is driven by a series of behavioural traits. We've already mentioned the illusion of knowledge feeding into it. So this idea that we've got better information, therefore we should be able to forecast accurately what's going to happen. Now, that in itself is not an outrageous statement, but the problem is we become biased. We become biased in that we think we're better than we actually are at forecasting information. So it's not that we, you know, it's not the fact that we have better information or that we're smarter that's an issue. It's that we think we're smarter than we actually are, or we think we have better information than we actually do, which gives us the ability to forecast better than we actually can. Don't forget, overconfidence is where you think you can forecast more accurately than you actually can. You also believe that you can remove risk through doing more work. You can remove risks when maybe you can't. So once again, it's not outrageous to say that you can mitigate risk by doing more research. That's fine, yes you can, but it's the problem that we over-represent how much risk we can remove, and that leads us to be overconfident. This is the illusion of control. Availability bias plays a role here. Thinking about things that are more easily recalled gives us more certainty, you know, about the future. You know, if we just recall, if we just think about information that's most easily recalled, maybe we don't think about all of the risks that are out there. Maybe we only think about certain scenarios, and that gives us confidence that we can forecast what's going to happen. It doesn't necessarily mean we think we can forecast good things, right? We're not overconfident in, say, a security's fortunes. For example, the thing that might be most easily recalled is the most recent market crash, and you might be thinking that might be 2 most in your mind, and might sway your forecasting and make you overconfident that that's going to happen again sometime soon. Another bias that plays a role here is representativeness. Representativeness is thinking that because the data that you've got is conforming to a view that you have, you know, it makes your view more accurate. The key thing here is that the available data, you're over-representing the role it should play in your forecasting. So don't forget, this data is either too small, don't forget the two key strands of representativeness, if you like, the two key causes. There's sample size bias or sample size neglect. Yeah, so maybe you're relying on too few data points or too little data to come to a conclusion, which makes you overconfident. And there's base rate neglect as well. That's lazy or base case neglect. All right. Base case neglect is really ignoring the base case, ignoring, through your labeling, you're kind of ignoring true probabilities. So base case neglect is lazy labeling, looking at a bit of data, over-representing how important that data is, and then throwing that investment into a bucket. You know, we saw an example earlier about a growth stock. Oh, it's a growth stock, right? Yeah, it's a growth stock. Okay, let's just forecast higher earnings. Now that's lazy labeling. That's neglecting the fact that there are growth stocks that don't have growing earnings, but they're still classified as growth. They don't have growing earnings right now, but they're still in the growth bucket. And it might be a lazy application of growth. It might not be a growth stock in the first place. So that's representativeness coming through and making us overconfident in our accuracy. And also, there is something with analysts. Analysts, you know, they're very public. They do need to maintain a reputation of being good at forecasting. So they're going to need to defend their reputation and their ego. All right? And this is kind of like... we see hindsight bias popping up in here, editing the past, underweighting things that they got wrong, and remembering things that they got right. All right, so editing the past is hindsight bias. Also, self-attribution bias, that's a new one here. This is where you take credit for things that were right. So that was me, yeah. So I said those things were going to go up and they did. So you take credit for the things that you got right. The things that you got wrong, you blame other factors. So we do this all the time. All right, so yeah, those things that I said that were going to go up that went up, that was me. All right, that's my genius, if you like. And I got that right. Those things that I said that were going to go up that didn't go up, that wasn't my fault. That was the Federal Reserve, or that was, you know, a weather system. Right? You see this all the time, particularly when politicians speak and central bankers speak. You hear self-attribution all the time. They take credit for the things that have gone right. Things that haven't gone right, it's not their fault. That's just the weather system or something, you know, like a financial markets that forces that they can't control. All right, that can feed through into overconfidence because that leads you to think that, yeah, you know, if you believe your own hype there, then you believe that, yes, you are good at predicting things, and the things that, you know, things that you don't predict, that's not your fault. All right. Now, the second strand, don't forget, we're talking about the two strands of things that affect analysts' forecasts. The second strand is company management. Company management, you know, they are going to be presenting information in a way, so framing information, making information easily accessible in a way that might bias the analyst's impression. So they might be making available data that makes the company look good. All right, so the company's sales are going up, and they'll just put that right in the front of the analyst. And margins are going down, but we don't necessarily see that quite so quickly. You'll see company presenting what are called pro forma earnings. Pro forma earnings are not accounting, if you like, they're not meeting GAAP, generally accepted accounting principle rules, but it's how the company wants to present earnings. So that's what's available, that's what the analyst sees. Chances are that's looking quite healthy and quite good. The way that they frame information, just the way that they present information, they present the positive things first and negative things second, or they tend to promote positive things to the top of a list, negative things later on, or maybe even framing could be as subtle as talking about being 95% confident instead of there's a 5% chance something could go wrong. This could anchor analysts. Analysts are likely to be anchored to their initial impressions. And if their initial impressions are favourable, you know, company management will be wanting to anchor the analyst's impressions, the analyst's view, to those initial impressions to put the company in the best light. So the idea here is that management are presenting best data first, framing it in a way such that we anchor analysts' initial impressions. Don't forget, first impressions stick is the saying, isn't it, to the best possible light. we might find that for the company management, not just the analyst, but overconfidence and the illusion of control, once again, overhyping how much control they have over the company's fortunes and how they interact with the market, and overconfidence in their ability to forecast, their ability to change the fortunes of the company, that might lead them to either consciously or subconsciously present the company in too favourable a light. And the other thing, of course, the old conflict of interest, that management get paid according to how well the company does, and they'll be wanting to present the company in the best light on the basis that they'll get paid more. So incentive compensation, how much management get paid, is linked to how well the company does, and so they'll want to present the company in the best light. All right, the third kind of strand here that affects the analyst's forecasts is biases in how they conduct their research and how they process their information. They're likely to suffer from confirmation bias. The way they process information, they're likely to be looking for things that already supports their conclusion to avoid the cognitive dissonance of processing conflicting information, because that's hard work, and also just losing face because that suggests that they were wrong. So confirmation bias is likely to be prevalent in analyst forecasts, and which might lead them to stick to their views when maybe they shouldn't. Assuming a sound company, a company that's got sound fundamentals, will be a good investment is also a problem as well. A sound company can be overvalued. A company can be very good, very well positioned, very good brand, very profitable, but that does not confirm that it's a good investment necessarily. It could be overvalued. All of that good soundness can be priced in and more, which makes it a bad investment that needs to go down. Needs to go down in order to be re-rated to its fair value. Other errors in processing here, these are new, so I'd pay attention to these. There's gambler's fallacy. Gambler's fallacy is where you think a trend is going to reverse with more likelihood than is actually the case. Gambler's fallacy is where you think mean reversion is going to happen with more likelihood than is the case. So once again, it's not that mean reversion doesn't happen. We're saying, mean reversion does happen, but what we're saying is that people tend to make mistakes and over-predict mean reversion, all right, in certain situations when, get the probability of mean reversion too high, right? Expect mean reversion when maybe it's not going to happen. Gambler's fallacy, it's called gambler's fallacy because it's a fallacy that's often seen when people are playing roulette, largely roulette, red and black. There's a bit of green going on, but largely red and black. And you'll see in a casino all of the last, however many spins you want to see. It's all right up there. Red, black, red, black, red, red, black. And it's gambler's fallacy to sit there and wait for a string of reds thinking that black is more likely. All right, this kind of mean reversion, that we should have the same amount of reds and blacks over the long term, which is true. We misapply that to think after a stream of reds, we're more likely to get a black. That's not true, all right? That's a misapplication of probability, and that is the classic gambler's fallacy, that a trend of reds means that a black is more likely. Probability of a black on the next spin is exactly the same as what it has always been. What is actually unlikely is what you've already seen, which is a stream of reds. That's actually quite unlikely. Stream of 14 reds in a row. That's the unlikely thing, and you've sat there and seen it. That's happened. Probability of a black going forward, same as it ever was. So that's why it's called gambler's fallacy. You're kind of expecting something to reverse when maybe it won't, or you're kind of over-representing the probability that it will reverse. Okay, overestimating the probability it will reverse. The opposite, where you think a trend is going to continue, that's called the hot hand fallacy, where you think something's won. This time it's going to win again, so let's play it again, and you over-represent. It's related to representativeness, isn't it? You over-represent something that has happened more, that's worked in the past into the future. Okay. All right. Now, mitigating these forecasting biases, it's all about being aware of them and being grown up enough to seek counter-arguments to a view that you already hold, really, and maintaining metrics as to how the decisions that you made and how your forecasts played out. That's crucial. It's, otherwise you'll edit out the things you got wrong. You won't hold yourself responsible. You won't really have a record, a quantitative record, a numerical record of why you made decisions and what you expected to happen. It's very easy to then just forget your mistakes if you do that. Think hindsight and self-attribution. Seek accurate feedback on your forecasts. Accurate and prompt feedback, all right, from the market as to whether you're any good at making forecasts or not, all right? And make sure you keep a log of past decisions and results. If you don't do that, then you're likely to fall into this trap of overconfidence, hindsight, bias, self-attribution, the sort of things that we've just chatted about. Okay, let's move on to the second scenario that we're going to be looking at here with regards to how behavioural finance plays a role, and that is investment committees. So investment committees are groups that make decisions together. So when a group comes together and makes a decision, people air their views into the group, and actually that situation could lead to people behaving differently to how they would behave if they were just thinking independently on their own. So it could exaggerate what's called social proof. Members just going along with the group because of psychological and emotional discomfort associated with being awkward and having a contrary opinion. That doesn't apply to everyone, does it? But most people on average don't want to rock the boat. We might go along with the group or a strong member in the group, a dominant person in the group, and that will lead to a kind of an echo chamber, won't it? You know, if everyone someone states a view and everyone else says, well, yeah, that's fine, I agree with that, and it kind of leads to this idea that we're overconfident in the decision that the group has made simply because no one has challenged it. Social proof, by the way, is the name for this idea that you tend to want to go along with the group rather than resist it. All right, not everyone, but on average that tends to be a trait. So that's a new word, isn't it? Well, that's a new phrase. Make sure you take that away, social proof. Key way of mitigating these kind of biases, once again, is to, is to have feedback on how the investment committee is doing. Also, to have members of the committee and contributors to the committee write their views down independently and bring them to the meeting and express them, all right, in that environment. They're not not making those decisions on the spot. That's another way of mitigating these kind of biases which lead to this echo chamber. You know, the echo chamber, that idea, that is, you know, all you're hearing is what you've already said. Okay, moving on from this, the third scenario that we're going to look at, and final scenario that's affected by behavioural traits, is market anomalies. You know, traditional finance can't really explain market anomalies where we have bubbles, where people get over exuberant, over greedy, and then busts, which leads to people getting over gloomy, over fearful. All right, traditional finance kind of says, well, people get their models wrong, there's problems with data, or it was just temporary. You know, over the longer term, markets are efficient. Traditional finance can't actually explain anomalies away, because traditional finance, with its assumption that we're rational economic man, and that is we have perfect information, perfect ability to process it, no errors, and therefore markets are efficient on average, it can't really explain market anomalies. Behavioural finance can. All right? Because of all the biases that we've spoken about throughout this chapter, behavioural finance can come up with ideas as to why we get bubbles, and we go up too much and then we get big crashes afterwards. So let's have a look at some of these ideas. There are some new terms being used here as well. Now, on the way up, as the bubble's building, and maybe on the way down as it's crashing, there's quite a lot of momentum there, and too much, that's the idea. This is the momentum effect. So in the kind of relatively short term, 2 years, what could add to that momentum effect? Well, generally speaking, we feel safer in a herd than we do alone. You know, we feel quite isolated when we're on our own. So investors tend to follow whatever is the consensus idea. So if something's in favour, it will work. That will tend to lead investors to herd together. And just from a kind of a reputation perspective, if something's working and you're not involved, it might damage your reputation as an investment manager. This is a key problem with financial markets. You know, when you look at some of the CEOs that were hauled up publicly in front of policymakers like governments after the credit crunch, a lot of them said, well, you know, if I hadn't joined in that sort of behaviour, then I would have been fired and we wouldn't have made that money. And, you know, to hell with the longer term consequences, we had to focus on what was making money at the time, which is not good long term. That can lead to big bubbles, which then subsequently end badly. Also, trend chasing is a classic reason for momentum in markets. Fear of missing out, really. Something's working, your clients are asking about it, so you join in. It's easier for you to kind of say, well, I was a little bit late, and it's easier to explain that way if everyone's suffering from a drawdown than it is to explain that you weren't involved in the first place. And don't forget the disposition effect of loss aversion. Loss aversion, where we hate losers more than we like winning. Loss aversion tends to mean we sell winners too early. All right, and we run losers for too long. Don't forget, it's all to do with the value function of prospect theory, where when we make gains, we don't get a massive upside. Yeah, it's nice, but it doesn't feel as good as how bad it feels when we suffer losses. All right. So the dot there is is your in price. So it hurts more when we lose, and that leads us to get very risk averse here. We don't want to lose. We don't want to fall off this cliff, so we're going to sell that. We've made a little bit of money. This dude down here, if we've lost money, this is quite a lot of. We become risk seeking. Quite a lot of upside here. So we'll hold on to this, or even, maybe even take more risk. But this is the disposition effect, a result of being loss averse, a key idea of prospect theory, as we've already seen. Now you might sort of say, well, why are you talking about this here, Stuart? This is the momentum effect. Why are you talking about this here? Well, think about how this will affect markets. If we sell winners too early, what are we doing? We're selling things down that should be going up. We should allow them to go up. They've got more to go. So we're putting pressure on things that should be going up. That means things don't adjust immediately. They will go up slowly, more slow than they should do, right? So when we sell winners too early, we're kind of selling too early. They'll kind of go up. The idea is they'll eventually adjust to then, when they have good news, they'll eventually adjust to their new intrinsic value. But the eager selling of market participants that are long and winning, that will stop it from going up and adjusting immediately, quickly, and you'll get this trend up over the relatively short to medium term. If we run losers too long, what we'll find is that we'll hold on to losers. We won't necessarily sell them when we should do, so they won't go down as fast as they should. They'll just keep going down over time. All right? So if we run losers too long, we should have sold them here, but we didn't. All right? So they keep, if you like, there's not selling pressure what there should be to reflect information. So it trends down slowly over time, more slowly over time than it should do. It should gap down, but it's trending down slowly because people aren't selling when they should. So that's actually quite a sophisticated application of the disposition effect, which is a consequence of loss aversion, which means we tend to move in trends over the short to medium term rather than jumping to new intrinsic values on news flow. So what else is in play here when we're thinking about bubbles and crashes? These are driven by unusual emotions, panicking, panic buying, panic selling, and it's unrelated to fundamentals. Buying is to do with the momentum effect, buying because something is working and confirmation feeding through that it's going up, so it's working. Confirmation is going to play a role here. Overconfidence, most definitely. Self-attribution, where things that you've bought in the past that didn't keep going up, you're kind of, that wasn't your fault, but things that you bought that were going up in the past and did keep going up, that was genius, all right, and that will work in the future. And just the fear of missing out again, regret aversion. So the fear of missing out, something's going up, so you pile in because you don't want to miss out. All right, that's that kind of fear of missing out application of regret aversion. So yes, I mean, some of this behavior can be rational. So if there's a lack of suitable investments in the market, or even you could argue it's rational to stay in inflated asset classes if you'd get fired for rotating out of it, because, like I said earlier, your clients wouldn't be happy if you're not in a theme that's working. That isn't great. That sounds like perverse incentives, but you could at least justify why you would buy something that's been going up on that basis. But the general idea is that these kind of behavioural traits, confirmation bias, overconfidence, self-attribution, regret, aversion, this fear of missing out, feeds into this momentum effect. The other thing at the market level, which is worth mentioning at this point, is the anomaly with regards to value stocks outperforming growth stocks over a full cycle. So value stocks are cheap from a kind of a multiples perspective. They tend to have low price to earnings, price to book. They tend to have high income yields. We'll talk more about this when we get into equities later on. Growth companies tend not to have low multiples. They've got high multiples, high PE, might not even have any earnings, high price to sales, high price to book, because we expect future growth from them. What we tend to find is over a full market cycle, so whatever that is, over a long enough time period where we've seen enough market conditions, value stocks tend to do better than growth stocks. They tend to outperform. Now you might view this as an anomaly. Behavioral finance suggests, it is a mispricing, and that it's not so much that value stocks are cheap. It might be more to do with growth stocks being overvalued. Growth getting attracting investors that tend to bid the share price up too much. There might be the halo effect that good growth implies good investment. We saw that earlier, didn't we? Looking at a company and thinking, well, it's a good company, therefore it must be a good investment. That doesn't necessarily flow through. That's called the halo effect here. This halo around the stock price because the company itself is a good company in terms of growth. And there's also home bias in play here as well. The best known companies, all right, best known companies tend to attract investment. There's an old saying, you don't get fired for buying, well, I won't give a brand name, but if you buy the best known stock, clients tend to know that. You don't tend to get fired for it. If you buy something that's unknown and it doesn't work, people will give you a lot more, clients will give you a lot more stress for that decision. So there is a bias towards things that are well known, things that have worked in the past. Think out there at the moment, some internet companies that are very well known. You can Google them if you will. Google, see what happens. It might be the case that there's a bias towards these kind of companies because they've worked. They've got high growth rates, but that makes them overvalued, and that could lead to these anomalies in markets. That could lead to the fact that growth stocks don't tend to do as well as value stocks after the overvaluation is corrected. Okay, now look, that does bring us to the end of behavioural finance, and I think for me personally, I know ethics came before this, but if you're studying the right way, you'll kind of put ethics to one side and study it alongside your in parallel with your other studies. So behavioural finance will be the first study session that you've actually looked at in your level 3 program. And at this stage, if anyone's feeling uncomfortable with it, it's quite a common feedback because people want more granularity than is actually there, and they don't like the fact that there's a little bit of overlap and different behavioural traits can lead to the same behaviour. So the examiner could write a question that I can't answer, and the answer to that is no, they won't. Okay, the CFA Institute does say that they do not write questions to catch people out. So don't worry about overlapping nature of this material. Don't worry about the fact that there's different traits that can lead to similar behaviour. As long as you understand what the trait is, as long as you understand what endowment bias is and what status quo bias is. I know they both lead investors to not do things when maybe they should do things, to just hold on to their existing portfolio. You should be confident that the exam is well defined enough and the CFA Institute has enough integrity that they will not write the question, hey, this is investor's not doing anything when they should be acting. Is that endowment or status quo? You should trust that the exam doesn't do that. You can see empirically that the examiner doesn't do that by looking at past papers. Give you some confidence. Go back and look at some behavioural questions in past papers over the last 10 years. What you'll find is it's very discreet, very explicit, and when different behavioural traits do come up, you're asked to pick from a list, and the ones that lead to similar behaviour are not there. There's only one of them there that you can pick. So it's very, very clear cut. So, this is one of the areas in the curriculum that you should really enjoy, because it really does explain how investors actually behave rather than how they should behave, which is what all we've seen so far in levels 1 and 2. So that concludes behavioural finance.